Imagine it's 1933. You're a dentist in Munich. You've spent 20 years building a modest practice. You own a small apartment building on Schillerstrasse. You have a savings account at Bayerische Vereinsbank with what should be enough to retire comfortably. You have gold coins, Reichsmarks, and government bonds. You've done everything right. Then, on the morning of April 26th, you open the newspaper and read Executive Order number 133 from the Reichsbank. All citizens are required to surrender gold holdings above a trivial amount to authorized banking institutions. Failure to comply carries a fine and imprisonment. Your savings account has already been frozen twice in the past 18 months. Your apartment building is now subject to a new emergency property levy, a tax you didn't vote for, that didn't exist 6 months ago, assessed on a valuation the government itself determined. You sit at your kitchen table and realize something that millions of people throughout history have realized too late. You don't own what you think you own. You hold it. You maintain it. You pay taxes on it. But when the state enters a fiscal crisis severe enough, the distinction between ownership and custodianship disappears, and it disappears fast. This isn't theory. This has happened in every major financial collapse in modern history. Germany in 1923 and 1933, the United States in 1933, Cyprus in 2013, Greece in 2015, Argentina in 2001, Venezuela starting in 2014, Lebanon in 2019. The mechanism varies. The outcome doesn't. When governments become insolvent, they don't disappear. They feed. And they feed on the most visible, the most registered, the most accessible assets their citizens hold. So the question that almost nobody asks before it matters, and almost everyone asks after it's too late, is this: what can't they take? Not what shouldn't they take, not what is it illegal for them to take. And legality is rewritten in a crisis. The question is architectural, structural. Which assets, by their very nature, by the physics of how they exist, resist confiscation, seizure, freezing, and forced conversion? That is what this video is about. And I want to be precise here. This is not a preparation guide. This is not financial advice. This is a historical and structural analysis of what has survived past collapses and why. The pattern is not hidden, it's just ignored. Let's begin. Before moving forward, there's a question that why governments seize assets in the first place. Before we identify what resists seizure, we need to understand the mechanism of seizure itself, because most people misunderstand it completely. They imagine soldiers knocking on doors. They imagine dramatic confiscation scenes. Sometimes that happens. But it's the least efficient method, and therefore the least common. The primary mechanism of government asset seizure in a financial crisis is not physical force. It is administrative access. Let me explain what that means. When you deposit money in a bank, you don't own that money anymore. Legally, you have made an unsecured loan to a financial institution. What you hold is a claim, a number on a screen. That claim is subject to the regulatory framework of the jurisdiction your bank operates in. And in a crisis, that framework changes. Cyprus, 2013. The government didn't send soldiers to people's homes. They simply changed the rules on a weekend. Bank deposits above 100,000 euros were subjected to a forced conversion. Depositors in Laiki Bank lost nearly everything above the insured amount. Depositors in Bank of Cyprus lost 47.5%. This was not theft in any legal sense. It was a bail-in, a word that didn't meaningfully exist in public consciousness before 2013, but that had been quietly built into European banking resolution frameworks for years before it was deployed. The money didn't move. The rules moved. Greece, 2015. Capital controls were imposed overnight. Citizens could withdraw a maximum of 60 euros per day from ATMs. Bank accounts were frozen. People who had 6 figures in savings watched it become inaccessible. Not confiscated in name, but confiscated in function. If you cannot access your money, you do not have money. You have a number. Argentina, 2001. The Corralito, bank accounts frozen. Dollar-denominated deposits forcibly converted to pesos at an artificial exchange rate. A person who had 100,000 US dollars in an Argentine bank account on December 1st had the equivalent of roughly $25,000 by February. The government didn't steal in the traditional sense. It converted. It redefined. It administered. This is the pattern. Governments don't need to take your assets if they can redefine them, freeze them, convert them, tax them retroactively, or simply change the rules under which you access them. So the structural question becomes, which assets exist outside administrative reach? Not outside legal reach. Laws can be written to cover anything, but outside practical, enforceable, administrative reach. There are 5 categories, and they share common characteristics. They are portable, or they are invisible, or they are intangible, or they exist in a domain the state cannot physically or digitally access, or they reside inside the one container no government has ever successfully opened. Let's go through them. Number 1, knowledge and skills. This is the asset that nobody lists on a balance sheet, and it is the single most seizure-resistant store of value in human history. Let me tell you about the Jewish professionals who fled Germany between 1933 and 1939. Doctors, engineers, physicists, chemists, musicians, mathematicians. They left behind everything. Real estate confiscated or sold at distressed prices under duress. Bank accounts frozen or taxed into insignificance. Businesses Aryanized, a polite word for stolen. Gold surrendered. Art looted. What they carried with them was the one thing the Reich could not stamp, register, freeze, or confiscate: their skills. Albert Einstein arrived in the United States in 1933 with virtually nothing in material terms. Within weeks, he had a position at the Institute for Advanced Study in Princeton. His wealth was not in a bank. It was in his brain, and that asset appreciated the moment he crossed the border. This pattern isn't unique to Nazi Germany. It repeats in every refugee crisis, every currency collapse, every political upheaval. The Vietnamese boat people of the late 1970s, the Cuban exiles of 1959 onward, the Lebanese diaspora after the Civil War, the Venezuelans leaving after 2015, the Syrians after 2011. In every case, the people who rebuilt fastest were not the ones who managed to smuggle out the most gold or cash. They were the ones who carried skills that had immediate market value in their destination. A surgeon who flees a collapsing country is still a surgeon. An electrician is still an electrician. A software engineer is still a software engineer. Their productive capacity is embedded in their nervous system. No executive order can extract it. No capital control can freeze it. No bail-in can convert it. No border guard can confiscate it. Now, let me be precise about what kind of knowledge we're talking about, not credentials. Credentials are pieces of paper issued by institutions within a jurisdiction. They can be revoked, unrecognized, or rendered meaningless by a collapse of the issuing authority. A law degree from the University of Caracas has limited utility in Miami. But the analytical thinking, the language skills, the ability to process complex documents, those transfer. The distinction is between institutional knowledge and functional knowledge. Institutional knowledge is jurisdiction dependent. Functional knowledge is universal. A person who understands how to weld, how to write code, how to grow food, how to repair engines, how to negotiate, how to teach, how to diagnose illness, that person carries an asset that has been liquid in every civilization, in every century, in every crisis, without exception. The historical evidence on this point is overwhelming. After the hyperinflation of Weimar Germany, the professionals who recovered fastest were not the ones who had hedged with foreign currency, though that helped. They were the ones whose skills remained in demand, regardless of what the Reichsmark was doing. A baker still needed to bake, a doctor still needed to treat patients. The currency changed, the need didn't. Think about what that means. In a world obsessed with financial assets, with portfolio diversification, with basis points and yield curves, the single most collapse-resistant, seizure-proof border-crossing store of value is something you can acquire for the cost of time, effort, and discipline. And yet almost no one frames skill acquisition as asset protection. Because it doesn't show up on a brokerage statement. Because you can't chart it. Because no financial advisor earns a commission on it. That doesn't make it less real. It makes it less visible. And in a seizure environment, invisibility is the point. Number 2, portable physical assets held outside the system. Now we move into more conventional territory, but with a critical distinction that most people miss. Gold is the asset everyone thinks of. And they're half right. Gold has functioned as a store of value for over 5,000 years. It is dense, meaning high value per unit of weight. It is durable. It does not corrode. It is universally recognized. It is divisible. It has no counterparty risk in physical form. These are real properties. They are not speculation. They are metallurgy and history. But here is where people go wrong. They think owning gold protects them. It doesn't. The form in which you own gold determines whether it protects you or exposes you. Gold held in a bank-safe deposit box is not outside the system. It is inside the system, in a locked room the government can access with a single court order or emergency decree. In 1933, Executive Order 6102, signed by Franklin Roosevelt, required all persons to deliver their gold coin, gold bullion, and gold certificates to a Federal Reserve Bank by May 1st. The penalty for noncompliance was a fine of up to $10,000, equivalent to roughly $220,000 today, or up to 10 years in prison, or both. Now, enforcement was imperfect. Many people simply didn't comply, and most were never prosecuted. But the people whose gold was in bank vaults and safe deposit boxes, in any registered, institutionally custodied form, had no option. The banks complied. The gold was surrendered. The individual's intention was irrelevant. The custodian's compliance was sufficient. This is the principle. The seizure resistance of a physical asset is inversely proportional to its institutional visibility. Gold you hold in your own possession, in a location known only to you, is structurally different from gold held in a registered vault, not legally different. Structurally different, one can be administratively seized. The other requires a physical search of a specific location that the authorities must first know about. The same principle applies to other portable physical stores of value. Gemstones, specifically diamonds above a certain quality threshold, have historically served this function. They are the most concentrated form of portable wealth ever created by nature. A single 1-carat D flawless diamond can be worth $15,000 to $20,000 and fits inside a shirt button. Refugees from every modern conflict have used gemstones to cross borders with wealth that metal detectors cannot find, that customs agents cannot easily identify, and that does not appear on any financial registry. I want to be careful here. I'm not recommending this. I'm documenting that it has happened repeatedly in every major crisis of the past century. And it has happened because the physics of the asset, small, light, undetectable, valuable, creates a natural resistance to seizure that no law can fully overcome. There's a historical account, difficult to verify but widely cited in refugee studies, of a Jewish family fleeing Belgium in 1940 with diamonds sewn into the lining of their coats. They crossed 4 borders. Everything else they owned was lost. The diamonds, converted to local currency at each stop, funded their survival for 3 years until they reached safety in Portugal and eventually Brazil. The mechanism here isn't cleverness. It's physics. An asset that is small enough to conceal, valuable enough to matter, and unregistered is an asset that exists outside the administrative reach of any government. But, and this is important, this category of asset has severe limitations. It is illiquid in normal times. It is difficult to authenticate without expertise. It is subject to loss, theft, and physical destruction. And it carries legal risk in many jurisdictions if undeclared. The very property that makes it seizure-resistant, invisibility, also makes it fragile in other ways. This is the trade-off. And it is inescapable. There is no asset that is simultaneously liquid, safe, visible, and seizure-proof. Those properties are in structural tension with each other. Anyone who tells you otherwise is selling something. Number 3, decentralized digital assets. This is the category that didn't exist before 2009, and it changes the calculus in ways that are genuinely unprecedented. Let me explain the structural property that matters, and only the structural property, not the price, not the speculation, not the hype. Bitcoin and a small number of similar decentralized cryptographic assets have one characteristic that no previous asset class in human history has possessed. They can be stored in your memory. Let me unpack that, because it sounds abstract, and it isn't. A Bitcoin wallet is controlled by a private key. The private key can be represented as a sequence of 12 or 24 common English words, called a seed phrase. If you memorize those words, you carry the key to your assets in your brain. There's no physical object to confiscate. There is no account to freeze. There's no custodian to compel. There is no border to cross with a declarable item. A person can walk through any airport in the world, cross any border, pass through any checkpoint, with millions of dollars in value accessible only through a sequence of words they have memorized. No scanner can detect it. No search can find it. No court order can freeze it, because there is no institution to serve the order to. This is not a theoretical capability. This has been done repeatedly. Documented cases exist of Chinese citizens moving wealth past capital controls using memorized seed phrases. Venezuelan refugees have crossed into Colombia carrying nothing, with their savings stored in 12 words they committed to memory. Afghan citizens, after the Taliban takeover in August 2021, accessed funds that had been frozen in every traditional banking channel through decentralized wallets that no authority, neither the Taliban nor the United States nor any international body, could seize. Now, let me be equally precise about the limitations, because intellectual honesty requires it. First, volatility. Bitcoin's price has dropped over 70% on multiple occasions. In 2022, it fell from roughly $69,000 to under $16,000. An asset that loses 3/4 of its value is a poor store of wealth in the short term, regardless of its seizure resistance. Seizure resistance means nothing if the value evaporates on its own. Second, technical risk. If you forget your seed phrase or store it improperly or make an error in a transaction, the assets are gone permanently. There's no customer service. There's no recovery mechanism. There is no court that can reverse a blockchain transaction. The same property that prevents government seizure also prevents personal recovery. That is not a bug. It is the architecture. Third, regulatory evolution. Governments are not static. On-ramps and off-ramps, the exchanges where people convert between crypto and fiat currency, are increasingly regulated, surveilled, and in some cases shut down. China banned cryptocurrency trading entirely. India has imposed a 30% tax on crypto gains, with no allowance for losses. The European Union's MICA framework imposes extensive reporting requirements. The United States Treasury's FinCEN has proposed rules that would require reporting of self-hosted wallet transactions. The asset itself may resist seizure, but the ability to use it, to convert it into goods, services, or local currency, depends on infrastructure that governments absolutely can and do control. So, the structural reality is this. Decentralized digital assets represent the most seizure-resistant form of transferable wealth ever created, but they carry volatility risk, technical risk, and increasing friction at the points of conversion. They are a tool with extraordinary properties and extraordinary limitations. The historical parallel is interesting. Gold in the 1930s and 1940s had a similar profile. Physically held gold was difficult to seize, but it was also difficult to spend. You couldn't walk into a grocery store with a gold coin in 1934 America and buy bread. You needed to convert it, and conversion points were monitored. The parallel is imperfect, but the structural tension is the same. Maximum seizure resistance often comes at the cost of maximum friction in daily use. Let that sink in. Number 4, foreign-held assets in stable jurisdictions. This is the category that the wealthy have understood for centuries and that the middle class almost never considers until it's too late. The principle is simple. A government's administrative power ends at its borders. An Argentine citizen who held $100,000 in a Buenos Aires bank in November 2001 lost the majority of that value through forced conversion during the Corralito. An Argentine citizen who held $100,000 in a Montevideo bank, 90 minutes away by ferry across the Rio de la Plata, lost nothing. The money was in Uruguay. Argentine law didn't apply to it. Argentine capital controls couldn't reach it. Argentine forced conversion couldn't touch it. Same person, same amount, same currency, different jurisdiction, entirely different outcome. This is not tax evasion. This is not money laundering. This is legal, declared, compliant diversification of jurisdictional risk. And it is the single most common strategy employed by individuals who have survived currency collapses with their wealth intact. The historical evidence is extensive. Before the fall of the Weimar Republic, wealthy German industrialists held assets in Switzerland, Sweden, and the Netherlands. When the hyperinflation destroyed the Reichsmark, when the currency literally became worth less than the paper it was printed on, those foreign-held assets retained their value entirely. The same families that were wiped out domestically survived through geographic diversification of their holdings. During the Greek crisis of 2015, an estimated 40 to 80 billion euros left Greek banks in the months before capital controls were imposed. Much of it went to banks in Germany, the UK, Switzerland, and Luxembourg. The people who moved early kept their money. The people who waited, who assumed the situation would resolve, who trusted that their government wouldn't freeze their accounts, lost access to their own savings for weeks. Some lost significant portions permanently. Lebanon, 2019 to present. The banking system effectively collapsed. Depositors with dollar-denominated accounts were told their dollars would be converted to Lebanese pounds at an artificially low exchange rate, a rate that bore no relationship to the actual black market exchange rate. A person with $100,000 in a Beirut bank saw that converted to a sum worth perhaps $10,000 to $15,000 in real purchasing power. Lebanese citizens who held funds in banks in Dubai, London, or Paris suffered no such loss. The mechanism is jurisdiction. A government in crisis will use every tool within its jurisdictional reach. But jurisdictional reach has hard boundaries. A court order from Buenos Aires does not bind a bank in Zurich. A decree from Beirut does not freeze an account in Singapore. Now, there are limitations and risks to this approach as well. Reporting requirements exist in most developed countries. U.S. citizens must file an FBAR, a foreign bank account report, for any foreign financial accounts exceeding $10,000 in aggregate. Failure to file carries severe penalties. Similar requirements exist in the EU, UK, Canada, Australia, and elsewhere. These reporting requirements don't negate the protection, but they do create a record. And records can be used to apply pressure, impose exit taxes, or create new retroactive obligations. There's also the risk that the foreign jurisdiction itself becomes unstable. Holding assets in a Cypriot bank to escape Greek risk would have been a catastrophic error in 2013, when Cyprus itself imposed bail-ins. Jurisdictional diversification requires choosing jurisdictions that are genuinely stable, that have strong rule of law, that have independent central banks, and that have a historical track record of respecting property rights, even under stress. Switzerland has been the canonical example for over a century, though its banking secrecy has eroded significantly since 2010 under international pressure. Singapore has emerged as an alternative, as have New Zealand, certain Canadian provinces, and select Caribbean jurisdictions with robust legal frameworks inherited from British common law. The structural principle remains. Assets held beyond a government's administrative border are assets that government cannot unilaterally seize. That principle is held in every financial crisis in modern history. It is not a guarantee. It is architecture. Number 5, social capital and community networks. This is the asset that no economist charts, no financial advisor mentions, and no government can see. And yet, in every societal collapse ever documented, it has been the single largest determinant of individual survival. Let me tell you about what happened in Argentina after the 2001 collapse. The formal economy essentially stopped functioning. Banks were closed, cash was scarce, unemployment hit over 25%. Poverty rates exceeded 50%, almost overnight, in a country that had been considered upper middle income. What emerged was a vast network of barter clubs, called Clubs de Truc. At their peak, these networks involved an estimated 6 million participants. People traded goods and services directly, using local credit notes as a medium of exchange. A baker would trade bread for a haircut. A mechanic would trade repair work for tutoring for his children. An accountant would do bookkeeping for a farmer in exchange for vegetables. The people who thrived in this system were not the ones who had the most money before the collapse. They were the ones who had the most relationships, the ones who were embedded in communities, the ones who were known, trusted, and owed favors. This is social capital, and it has properties that make it structurally immune to every form of government seizure. You cannot freeze a relationship. You cannot impose capital controls on trust. You cannot bail in a reputation. You cannot retroactively tax a favor owed. You cannot confiscate the fact that your neighbor knows you're reliable and will feed your children if things get bad, because you did the same for theirs during the last crisis. The historical precedent here goes back much further than Argentina. During the Soviet collapse of 1991, the formal economy disintegrated almost overnight. What replaced it was BLAT, the Russian system of informal networks, personal connections, and reciprocal favors that had operated in the shadows of the Soviet bureaucracy for decades. People who had extensive BLAT networks survived the transition. People who had relied entirely on the formal system, on state salaries, state pensions, state distributed goods, were devastated. In post-war Germany, the Trümmerfrauen, the rubble women who cleared the bombed cities, organized themselves into informal mutual aid networks that shared food, childcare, and labor. These networks had no legal structure, no financial accounts, no taxable assets. They were pure social capital, and they were the primary mechanism through which millions of Germans survived the period between the end of the war and the currency reform of 1948. The same pattern appears in every disaster, natural or financial. After Hurricane Katrina in 2005, studies showed that the single largest predictor of survival and recovery speed was not wealth, not insurance coverage, not government aid. It was social connectedness. People with strong community ties were rescued faster, received more informal aid, rebuilt sooner, and reported better psychological outcomes than wealthier individuals who were socially isolated. Think about what this means for the question we're examining. In a financial collapse, the government will attempt to seize, freeze, tax, or convert every financial asset it can administratively reach. It will use the banking system, the tax system, the legal system, and if necessary, the physical coercion apparatus of the state. It will do this not because it is evil, but because it is insolvent, and insolvent entities consume whatever is within reach. This is not ideology, it is math. But social capital exists in a domain the state cannot access. It is stored in the minds and habits of other human beings. It is denominated in trust, reciprocity, and shared history. It cannot be digitized, registered, reported, frozen, or seized. It is the ultimate off-balance sheet asset. And here is the part that should unsettle you. Modern life, particularly in developed Western economies, has systematically eroded social capital for decades. Robert Putnam documented this exhaustively in Bowling Alone, published in 2000. Church attendance, union membership, civic organization participation, neighborhood socializing, and even informal dinner parties have all declined dramatically since the 1960s. The average American in 2024 has fewer close friends, fewer community ties, and less neighborhood interaction than at any measured point in history. Which means that in precisely the societies most likely to experience a financial crisis, driven by unsustainable sovereign debt, the population is simultaneously the most financially exposed and the most socially isolated. They hold their wealth in the forms most accessible to government seizure and their social capital at historic lows. That is not a coincidence, but it is a trap. Now let's step back and look at the structural pattern across all 5 of these categories. Knowledge and skills, portable physical assets held outside institutional custody, decentralized digital assets, foreign-held assets in stable jurisdictions, social capital and community networks. What do they share? They share one property. They exist outside the administrative graph. Let me explain what I mean by that. Modern governments do not govern people directly. They govern through systems, banking systems, tax systems, property registration systems, corporate registration systems, employment systems. These systems create a map, a graph, of every citizen's financial existence. Every account, every property title, every paycheck, every investment, every transaction flows through nodes that the government can observe, regulate, and in a crisis, control. When a government becomes fiscally desperate, It doesn't need to know where you live or what you look like. It needs to know where your assets sit in the administrative graph. If your wealth is in a bank, it's visible. If your property is registered, it's visible. If your income flows through an employer, it's visible. If your investments are in a brokerage, they're visible. Seizure is not a function of political will alone. It is a function of visibility plus administrative access. Both are necessary. If the government can see the asset but can't reach it, that's the foreign jurisdiction case. If the government can theoretically reach the asset but can't see it, that's the physical possession case. If the government can neither see it nor reach it, that's the knowledge, skills, and social capital case. The 5 categories I've described are not a portfolio. They are not an investment strategy. They are a taxonomy of what falls outside the administrative graph. And history demonstrates, repeatedly and without exception, that when a government enters fiscal crisis, it harvests everything inside the graph and cannot reach what is outside it. This is not about good governments and bad governments. This is about the behavior of insolvent institutions. An insolvent institution, whether it's a government, a corporation, or a pension fund, will consume accessible resources to survive. It is not a choice. It is the institutional equivalent of a biological imperative. Survival overrides principle. It always has. It always will. The United States government in 1933 was led by Franklin Roosevelt, widely considered one of the most popular and well-intentioned presidents in American history. He signed Executive Order 6102 anyway, because the gold reserve was depleting and the dollar peg was unsustainable. Good intentions did not change the math. Good intentions never change the math. I presented historical examples from the 1920s, 1930s, 1940s, 2001, 2013, 2015, 2019. A skeptic might reasonably ask, why does this matter now? Are we facing conditions comparable to those crises? Let me present the math without commentary and let you draw your own conclusion. The United States federal debt as of early 2025 exceeds $36 trillion. The annual deficit is running at approximately $1.8 to $2 trillion. Interest payments on the debt have surpassed $1 trillion annually, exceeding the defense budget for the first time in American history. The Congressional Budget Office projects that under current law, with no recession, no war, no crisis, the debt to GDP ratio will exceed 150% by 2050. The last time a major Western democracy sustained a debt to GDP ratio above 150% without either defaulting, inflating, or restructuring was never. Japan currently operates at a debt to GDP ratio above 260%, sustained only through financial repression, in which the Bank of Japan holds over 50% of all outstanding government bonds and maintains artificially suppressed interest rates that effectively tax savers through below-inflation returns. Japan has not defaulted. T, it has imposed a silent, continuous seizure on its citizens' savings through 3 decades of zero or negative real interest rates. A Japanese saver who held government bonds from 1990 to 2020 earned virtually nothing in real terms. That is confiscation. It just doesn't look like it. The European Union faces a similar trajectory. Italy's debt to GDP ratio exceeds 140%. France has breached 110%. The European Central Bank's balance sheet expanded from roughly 2 trillion euros in 2014 to nearly 9 trillion at its peak. These are not signs of stability. They are signs of a system that requires ever-increasing intervention to maintain the appearance of normalcy. The constraint is mathematical. When interest payments consume an ever-growing share of government revenue, and revenue cannot grow fast enough to cover both interest and existing obligations like Social Security, Medicare, defense, and infrastructure, there are only 3 options. 1. Default. Politically impossible for a reserve currency issuer. 2. Inflate. Politically easier, but it is itself a form of seizure, a tax on every holder of currency-denominated assets. 3. Direct seizure. Tax increases, wealth taxes, bail-ins, capital controls, forced conversion of retirement accounts into government bonds, elimination of cash, restriction of capital flows. None of these are painless. All of them have precedent, and all of them target assets that exist within the administrative graph. That's the trap. Let me bring this back to the dentist in Munich. He lost his gold to Executive Order 133. He lost his savings to currency destruction. He lost his property to emergency levies. He lost his bonds to a government that would, within 12 years, cease to exist entirely. But the dentist, who also spoke French, who had maintained relationships with colleagues in Zurich, who had placed some savings in a Geneva bank account, who had invested in his own surgical skills and kept up with the latest techniques, who was known in his community as someone who could be relied upon. The dentist had options. Not perfect options, not comfortable options, but options. And in a crisis, options are the only wealth that matters. The pattern across all 5 categories is the same. The assets that survive a seizure are the ones that exist in domains the state cannot administer. The mind, the body, the foreign jurisdiction, the decentralized network, the community. These are not theoretical constructs. They are historical observations, drawn from every major financial collapse of the past century. The people who survived with their wealth and dignity intact were not the ones who had the most. They were the ones who had the most in the right places. This is historical and educational analysis. It is not financial advice. It is not a recommendation to take any specific action. Every individual's circumstances are different, and every jurisdiction has its own legal requirements regarding asset declaration, tax compliance, and capital flows. Nothing in this analysis should be construed as encouragement to violate any applicable law. Here's what I keep coming back to. Every generation believes it is exempt from the patterns that governed previous generations. Every generation holds its wealth in the forms most convenient, most conventional, most institutionally endorsed. And every generation that faces a fiscal crisis discovers the same truth that the dentist in Munich discovered, that the depositor in Cyprus discovered, that the saver in Argentina discovered, that the account holder in Beirut discovered. Convenience and safety are not the same thing. They are often opposites. The most convenient asset is the one most easily seized because convenience requires institutional infrastructure. And institutional infrastructure is what governments control. The question is not whether your government would do this. The question is whether the math will eventually require it. And if the math requires it, history tells us clearly and without exception what happens next. The pattern is already in motion. The debt is already unsustainable. The tools of seizure, digital surveillance, bail-in frameworks, capital controls, central bank digital currencies with programmable restrictions are already being built, not in secret, in public, published in white papers, discussed at central bank conferences, legislated in regulatory frameworks. The architecture of the next seizure is being constructed while most people are still debating whether it could happen here. It has always happened there, wherever there was at the time. And there was always a place whose citizens believed they were different, that their institutions were stronger, that their rights were more durable, that their government wouldn't, until it did. The question isn't if, the question is what exists outside the graph when it does. This channel doesn't predict the future, it dissects the past, because the past has already told us everything we need to know. Most people just don't look at it until they're already inside it. If that way of thinking is useful to you, you know what to do. Most of what you just heard will never appear on mainstream financial channels. Not because it's wrong, but because it's inconvenient. This channel exists to study the fractures before they become fault lines, to read the autopsy reports that most people won't open until they're already on the table. If you made it this far, you're not the average viewer. You're the kind of person who'd rather understand the machine than be processed by it. Subscribe, because the next analysis is already being written, and the patterns we cover next are ones you will not hear anywhere else. Turn on notifications. Not because I'll tell you what to do, but because when the next piece of documented history lands, you'll want to see it before it becomes relevant in ways nobody predicted. The people who understand these systems early don't panic, they position. And that starts with knowing what almost nobody else knows.